Home First did well. Maybe we should look at IndusInd. We should look at maybe PSU banks. Nifty PSU perhaps index should come up on your screen. It'll give you a sense of whether there is a little bit of buoyancy there or not.
Banks, capital market plays, Nifty Financial, Nifty Bank, Nifty PSU Bank, all financial indices leading from the front. It looks like a turbocharged opening, 157 points higher is what we'll get. And we would have broken through the top of our trading range as well.
Absolutely. So first rates coming up, indices, and then let's always look at stocks. What do we have coming up on your screens? 25,160. So yeah, 25,116 was that upper end of that range. That's taken out. And we are now slightly above it. So 25,114 on the index, 0.5% higher with a 100-plus point gain. Nifty Bank is up, of course, at 300 points, 56,872, 880. Sensex, 400-point gain, 82,590. Mid-cap index is up 0.6. So actually, broader market's doing even better. Small-cap index is up 0.85. So 18,740 on the Nifty small-cap index. So this Monday, we're kicking things off in style once again with strong gains. And I think financials are top of the pack. As you can see, I think it's mostly all financials. If you just look at the first row out there, two names on the Nifty, the heat map on your screen, just two names in the red. Surabhi.
Yeah, absolutely. Absolutely financials all the way. And it's across the board. But even smaller stocks like a Repco Home, for instance, markets very quickly moving on to Tier 2 and Tier 3 financials as well. Anyway, on the large cap screen, let's take a look at the top honors. Shriram Finance, 3.5% up. IndusInd Bank, 1.3%. Axis, which Bernstein just outlined as one of their top picks, 1.5% higher. Jio Finance, Kotak Mahindra Bank, everything is up and about. But even beyond, I mean, it's a good morning because you're seeing names like Reliance fire up, M&M, Trent, BEL, L&T, Maruti. By the way, auto stocks have revved up. I mean, is this the kind of liquidity bazooka and easing rate cycle you need to get auto, names firing again? Even Hyundai, check Hyundai. The opening trade that came in was about 3.5% higher on Hyundai. And Maruti anyway is higher. Look at Hyundai Motor go 6% up on that stock. What a move coming through. So autos are definitely revved up. Bajaj Finance about 0.5% higher. Adani Ports, and everything's up and about. It's that kind of a morning. Tech is also doing okay. Infosys 1% higher. TCS is seeing some gains as well. Remember, today is the Apple big event in the U.S. session today. On the downside, Nestle, Apollo Hospitals seeing a little bit of red. That's about it. Not too much. SBI Life also cooling off a little bit. But it's not even, these are not even cuts of 0.5%. Very, very positive morning. 130 points up on the Nifty.
Well, that's right, Surabhi. And just take a look at the big movers actually from the broader markets. Afcons, they've got an LOA worth around 700 crores from Reliance Industries. That's off to the races. Big move is what we're seeing out there. MCX, that stock in fact is up and about in today's trading session because that one has received SEBI's nod to launch electricity derivatives. So that's good news for them. And also IEX is higher because they have an agreement with MCX for underlying prices. So that explains why that stock as well is up close to around 2% or thereabouts as we speak. What else is moving? RITES, they have an MOU with Hindustan Copper for critical mineral supply chain in India and overseas. We'll wait by for details. But RITES, in fact, is higher as well with a gain of close to around 2%. RailTel, they won an order of around 250 crores. So that stock has opened up well in the green. PNC Infra had a big run last week. They've got an LOI for an EPC project worth around 240 crores. So that one as well continues to run ahead. And SPL Infra, they've got an allotment for land for their battery energy storage system manufacturing unit. The street likes anything with regard which has these names. So SPML Infra, smaller name. That stock, in fact, is up and about. And the cement companies, remember, there's a bit of negative news flow with regard to the West Bengal government not releasing or not going according to the incentives. But most of these companies actually were not factoring in any kind of money coming in from the West Bengal government. So explains why Dalmia Bharat is down only 1% or thereabouts. Novoco, that's down 1% or thereabouts. So we're not seeing such a large hit, though it's sentimentally negative. The point is that, in fact, most of these companies, they're either provided or they've created a provision or, in fact, they were not expecting it at all. So explains why these stocks are more or less stable in trade.
On Hyundai, I just want to add, I was trying to see if there's any fresh news flow. And the only thing that I could find was there's a lot of chatter about more upcoming launches, including a new compact SUV. I don't know if that's something that's gotten the market excited because while all auto stocks are up, this one is definitely seeing outsized gains this morning.
No, absolutely. So just a few other names, right? So 100 points, we are just around the upper end of the range, which is 25,116. We breached that, and now we're just under it. We're at it, actually, for all practical purposes. The biggest volume-led gainer is Shriram Finance with a 2% gain. So 700 on Shriram Finance. There is, actually, Balu Forge is coming up on my screen within the top 5 volume-led gainers. Balu Forge is up 10%, 11%. Almost a million, coming up to almost a million shares already very quickly. Another name is Shakti Pumps, which is, I think, almost back in 4 digits. So 990 or so, 5%. I think Friday moved up sharply as well. So I'm trying to, of course, financials are doing well, but I'm trying to look at other stuff. KEC is up about 2.25%. Again, very large volumes. You've got Time Techno, I think we mentioned it. Motilal Oswal has come out with a coverage this morning. So 3% initiating note from them. Shankara Buildcon has been jumping up. So Shankara, Friday was a big day, and today it's up another 11-12% on very large volumes here. And of course, Nippon India has come up very sharply, from $500 to $800 in, just 3 months or so. So that is doing very, very well. On the downside, Swiggy is down 4%. That's the only big notable loser, 360, and has got the second highest volumes on the downside. Cochin Shipyard is down about 2% as well. That's number one in terms of volume-led losses that you've got going at this stage. So we'll, of course, track this one as we go along. But Rana Gupta is with us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here. Thank you very much. It's rare to see what the RBI did on Friday, but we've had, you go back last 2 decades, instances where, authorities have tried to pump prime a little bit at the margin, push growth really hard. From a monetary perspective, Rana, beyond the near-term sort of moves that we will see, some sentiment-led, some justified, etc., will this make a real difference to boosting growth, boosting demand on the ground? And what would you take a call on a more durable basis beyond the first 2-3 days?
Sure. Good morning, and thanks for having me. So, no, it should. There is this old saying that don't fight the central banks. I think that's true for the markets as well as the real economy. I think given the liquidity boost that has come, or the rate cuts that have come, and the liquidity boost that's going to come throughout the year, in that way you can call it a bit of a forward guidance on the liquidity because the other cuts will phase in. I think the banks, the lenders, they will be now kind of going out and lend. In fact, we met some of the bank and the non-banks. They were still not very bullish on the deposit and loan growth, but I think this policy is significant and it changes things a bit. And it has been our call that tax cut plus monetary policy will be supportive. And I think the pro-cyclical monetary policy that has come, that will go a long way to boost liquidity, cut rates, increase deposit and lending growth, as well as boost demand on the ground.
Rana, great to have you on this morning. Very, very strong morning for the bulls, right? Because they've finally broken out of a 17-day trading range. It's been a long period of consolidation for the index. Market as a whole, now that we've got this, turbocharged move from the RBI, anyway, the income tax rate cuts have come in. Some are expecting that even maybe on GST, we could see a relief next month. What lies ahead? What is the approach that you would take to this market, say, for the next at least 6 months? Mid caps versus small caps, what part of the market to buy? Because we're again at very close to all-time highs now.
Sure. We are getting close to all-time highs, but we were at these levels in September last year. In fact, now 9 months, the market has not gone much or anywhere. I think that being said, I think it's very important for us to get the sectors right, and within the sector, we can look at stocks across the market cap given the risk-reward framework. I think the supplier of credit, like the banks and the non-banks, they will benefit as the credit growth picks up. The banks, the margin contraction that was earlier thought will be lower than that because of the CRR cut that's going to come in the H2 of this year. Non-banks, I think we'll see the margin expanding and growth, so that's all positive. We have been also bullish on the financial services companies like brokers, asset managers, distributors, wealth managers. So I think all this in a very good spot. On the other hand, I think the user of credit, they will also benefit, and they can broadly put in two buckets. One is consumer, and one can think about auto, retail, and travel. These are typically levered consumption that should do well. Also, I think one should be bullish on the infrastructure stocks. Now, infrastructure, I don't mean the construction companies or the capital goods companies. I simply mean companies who own all the infrastructures. It could be companies like telecom companies, hospital companies, hotel, it can be oil and gas, can be power and real estate. Those infrastructure companies who have large asset bases, they tend to benefit because of better top line growth. Their interest costs come down because many times these are very levered entities. Also, what happens is that their valuation improves as the rates fall down because they're long duration businesses. So I think we would focus on these sectors and across market cap ranges.
All right. Hi, Rana. Good morning. Good to see you. When you mentioned asset managers, distributors, wealth managers as well, but exchanges were left out. Do you think that they've got too expensive? BSE has been running on steroids. MCX as well, similar is the case. And IEX, after get bombed out, that stock as well has moved quite well. So the listed stocks are doing well. And in the unlisted space, NCX is doing a number of its own. You're interested in stock exchanges or not?
I think it depends on the investor risk reward profile. See, exchanges are probably the highest beta play on the volumes and liquidity in the exchange, as compared to that in I think a distributor or a wealth manager or insurance, you get a more diversified play with multiple earning drivers. So therefore, it's our preference to buy companies with diversified revenue streams. That being said, I think the exchanges remain the high beta play, and they may continue to do well. But I think the risk reward from our framework is better in the distributor companies like insurance or wealth managers.
Mm-hmm.
Okay, that's a point taken. By the way, lots of new stuff is coming up, right? I mean, AB Capital, if you can pull it up, is up 3.5%, and 242 on AB Capital. These are smaller names. Jana Small Finance Bank is up about 4% right now. Again, coming up with decent kind of gains. Fusion, I think on Friday did very well. It's up another 4% or so. You've got, lots of stuff. So 1,800 names are higher and about 600 stocks are lower at this point in time. Rana, the other point is, and this is, I guess you'd broadly agree, but the question is what to do. New ideas, hard to come by, right? It's a very finely priced market, 22 at a headline level, 22, 23 times earnings, P multiple. So you got to find newer things. It is hard, isn't it, Rana? So where exactly are you looking if you kind of sort of spread out the canvas away from just financials and capital market plays, etc.?
I think so. Away from financial capital markets, first of all, I don't think the financials valuation, of course, barring exchanges, the financials valuations are not that high. So I think financials valuation was do okay. And if you look at the stock sectors that we discussed, the consumer sector has been one of the more expensive sectors in India. And we are comfortable with that because, the retail companies, the travel companies, they are growing at a much faster rate. Still, the valuation is compared to much slower growing consumer staples kind of companies. So we are also taking a bit of a relative call there as well. And aviation is, of course, another play on the travel spend, and that's valuation is reasonable. But outside that, the other broad sector that I said, which is like telecom, hospitals, power, real estate, there the valuations are actually quite reasonable. So I think as the dust settles, as people figure out where the most benefit they see, I think with economic growth, their top line is going to grow, their interest cost is going to come down, and their valuation would improve. Real estate is also one sector. I think real estate power sector would highlight within infrastructure, where I think both you get good top line action as well as comfortable valuation. And maybe I just quickly also add to that, that I think you will see over a period of time, next 6 months, quite a bit of supply in the stock market from these kind of sectors. So I think that should ease the valuation a bit and also give us more choices.
Okay, fair enough. Power generation is what you mean, Rana?
I mean, particularly on the renewable power side, because renewable power, the growth story is very good. And if you look at the way the bidding is structured, the price is sort of fixed or levelized. And so that the developer could retain that benefit of all the prices going down. So let's say the solar cell price goes down, the interest cost go down, interest rates go down, that benefit they can retain. So future auctions will become even more competitive, but someone who has already won those bids will stand to make more profits than earlier thought.
So just as an example, what kind of names, Rana? Just purely for illustration purposes.
I would say that even in the utility, look at the companies who are already won significant renewable bids. Those companies are something that we would be quite bullish on.
Okay, and the others you said is so there is power. You said real estate and hospitals as well. And any preferences in the other in real estate and hospitals? Anything or broadly? I mean, all okay.
I think real estate so far we have been running with so far we have been bullish on the company which owns the land bank to a large extent and debt free, but that's because the view on the cycle was tentative. But with interest rate cuts and all that liquidity coming in, the confidence of cycle is improving again. And now I think it's a time to even go for some smaller, mid cap kind of real estate companies also, where they have taken debt to build up a income stream. Like for example, let's say a commercial or office stream, because commercial office properties will do well. On the other hand, interest costs will go down. So I think look for companies which has significant commercial or hotel revenues as a part of their NAV. I think we see some benefit of the rate cuts.
Okay, very quickly, Rana, before we let you go, your view on metals and particularly the non-ferrous space. Silver prices are perked up all of a sudden. You have a special situation playing out in Vedanta, though things are a little bit jittery as well because of President Trump. Don't know what he's going to do next.
So exactly, let me pick up the answer from your last line. We don't know what he's going to do next. But we know Indian policymakers are doing whatever they can to revive growth, and we don't want to fight that. So my views on metals are not even important. We will put money where we see more clarity, and that is typically Indian domestic cyclicals and risk sensitives.
Thanks, Rana, for joining in and filling us in with your take on the markets as well as individual sectors that we discussed. But talking about metals, let's focus on Hindustan Zinc. They'll be holding their board meeting in the next couple of days, June 11th, to consider interim dividend for this fiscal. So we'll wait to hear on that front. It appears the street is a little bit excited because of that as well. But for the time being, let's focus on the spurt that we have seen in silver prices, which have hit the highest levels globally that we have seen all the way since 2012. We're now joined by Mr. Arun Mishra, the CEO and whole-time director at Hindustan Zinc. Hi, Mr. Mishra. Good morning. It's always a pleasure speaking to you, sir. Well, silver prices hitting record levels on a day-to-day basis. Here in India, it's at peak levels. But let's focus on the globe first. Tell us about the demand-supply gap. And do you expect the deficit that we have seen in the last couple of years to continue?
No, the supply-demand gap on silver has started increasing from year before last, and as time goes by, demand is far outperforming compared to the supply, and it will likely to be in all predictions that I see till 2030. Silver prices are likely to go up only. There is no coming back on silver prices for next 4 to 5 years.
You expect silver prices to move up in the next 4 to 5 years and you're expecting the deficit to persist till 2030. Got that. Now, since silver is not just a precious metal, it's also an industrial commodity. Can you tell us about the demand surge you're expecting across various sectors? We talk about the EV space, the solar industries as well. So if you could tell us, how are you reading the situation with regard to demand for silver?
So first part, I would say consumer electronics is increasing day by day, and that is also having a lot of silver consumption, be it in the silver paste forms, which goes into circuit board electronics, or silver wool form, which goes into very fine contacts in high-end electronics that we use. More and more cars, modern auto, whether EV or without EV also, are being packed with as much electronics as possible. Hardly any car is there where, from ignition to infotainment systems, extremely packed with electronics. And that's also is a factor of reason for high silver consumption. And then you will look at solar energy itself requiring high amount of connectivity for solar cells, requires huge amount of silver consumption. And this goes on the newer areas which will come in, tinting of glasses on windows will have a little bit of silver coating, which will reduce the temperature. So more and more the world will try to be climate resistant or climate resilient. You will see newer applications of silver coming in, which will again increase the demand. It will not reduce the demand in any case.
Now, got that. So, since demand is so strong, what does it mean for silver prices? I mean, if you want to hazard a estimate, and also, how do you see the gold-silver ratio move from here?
So, if I have to do a crystal ball gazing, take 26 end or 27 beginning, anywhere close to $41 a troy ounce is the number that I'm looking at, which is now 36. It will go up by another $6 by 26 end or 27 January, February or so. That is the number I'm looking to. Most of the analysts are also saying that number. Some of them are predicting 50, but I'm not that bullish. 41, 42 is something achievable. Second, you are saying the ratio. I think it has come to a new level where the prices are same apart from the weightage. That is, for a 10 grams of gold is equivalent to 1 kg of silver. Now the ratios will not be spoken in terms of the price. It will be spoken in terms of what is the equivalent weightage giving you the same money. It has come to 1 kg is to 10 gram now. And I'm sure more and more it will be closing the gap even further.
Yeah, it's interesting. And if you look at the ratio, Mr. Mishra, it was at around 1. If you look at gold to silver ratio, that's come down to 0.94. And normally we have seen it goes to even 0.7. So then, in fact, silver prices could catch up. We'll see how that goes. But, given that silver pricing demand is strong, how will you change your sales mix? Do you think that for this fiscal, you have guided from 700, 710 tons on silver. Do you think you want to tweak that a little bit?
We are working with that, and maybe this quarter results when we discuss, we'll be able to say whether I'm making a strategic shift towards producing more silver, including mining those areas where we have better silver, and also there's the operating strategy that can we reduce zinc and produce more silver. Yes, it's on the cards, but I think July I will be able to announce after the quarter results are out.
So it's silver is really sparkling. Got that point, Mr. Mishra. So since the market is so buoyant right now, would it make sense for you to look at unlocking value in your silver business?
Absolutely. We will go back on that proposal of making that silver company as a separate company, work with all the stakeholders and see because that is where the value lies now.
So do you have any timelines in mind? I mean, could it be maybe 26 is early, maybe 27, that we see a separate silver unit listed here in India?
I would love to have that. And we still have time. While we are growing at the same time, we are expanding, we are in the process of placing orders for new smelters and mines expansion. I can see by 2027, our silver numbers will be close to 1,000 tons. If that be the case, we should have the silver company by that time, and that should be the realistic time frame.
Okay, now one more price estimate, as you said, take out the crystal ball once again, sir. Zinc prices, what's the outlook?
Zinc will not grow much because I am not seeing any push for zinc to be, as high as 34 or something. It will keep on fluctuating, as I said earlier also, 2,700 to 2,900. More closer to 27 of the band, it will be there. And it will continue at least for next 1 year or so.
All right, final question, Mr. Mishra. The other big buzzword nowadays is rare earth magnets. Is Hindustan Zinc exploring a move into rare earth magnets? As there's a supply threat, well, they've made various conglomerates look in this direction. So will it be via Hindustan Zinc, if at all?
No, so we are participating in any minerals or new auctions that are happening. Whether it is rare earth, whether it is critical minerals, anything that is happening, we are part of it. And Vedanta, being a resource company, also globally will always look for possibilities of new resources coming up anywhere. As far as we are concerned in Hindustan Zinc, we will look at any opportunity of mining. We already have got a few blocks where we have been declared as a preferential bidder. We have just got potters. We had got gold, but which was cancelled later on. But then we have got tungsten blocks. So we will look at more and more such blocks which are coming out, and we will be participating there.
All right, Mr. Mishra, good to speak to you. Thanks a lot for joining in. Silver is expected to be in deficit till 2030. You're expecting prices to go to around $42 an ounce by the end of 2026 or early 2027. And we'll wait by for the next month. When you announce your results, you'll tell us whether or not you're tweaking that guidance with regard to silver production. Thanks a lot for joining in. Well, on that note, we'll slip into a short break. On the other side, we have Mr. Ishwar Iyer of IGI, who's waiting by to talk to us about how business is progressing.
Well, it's a pretty okay morning of trade, but do keep an eye out from the top as well. I mean, sustaining at these levels is going to be critical. The Nifty opened with a 150-point gap. Now it's about 90 points higher. So let's see, 25,100 thereabouts. That's where we're at. Let's pull up the intraday chart if we can. It'll give us a sense. Early morning, start with a flourish. You'd want to hold on to the flourish through the course of the day. But we continue our interactions with the management. So the next company on our radar is IGI. Now, GIA India has been redefining the diamond grading norms by dropping the traditional 4Cs system. This is the latest news in the diamond world in the last week, 10 days or so. That basically GIC, which is very big into diamond certification, they have decided to completely segregate the way natural diamonds are graded and the way lab-grown diamonds are graded, perhaps to drive a deeper, clear cut between the two categories of diamonds. So natural diamonds will continue to get the 4Cs, clarity, cut, color, etc. But for lab-grown, according to GIA, it will be a very simple certification of whether it's premium or whether it's standard. And if it's a very low-quality lab-grown diamond, then they won't certify it at all. I mean, there'll be no term given to it. So how does this impact, the overall market and the business for International Gemological Institute? We have Mr. Iyer, the Chief Financial Officer of IGI, joining in to weigh in on this. Mr. Iyer, great to have you on. Thanks for joining in. So this is what we really want to understand at the heart of it all. Just start by telling us how much of your revenue, and club the stones as well as jewelry, how much of your revenue is right now coming from lab-grown and how much is coming from natural? Because the bulk of it, I think if I club both the categories, and I think 60, if not higher, % of your revenue is coming from the lab-grown side. But you tell us the latest numbers.
Yeah, hi, good morning, everybody, and thanks for having me on the call. It's a pleasure to be on this call, as always. And yeah, from basis what we discussed post my Q1 results discussion, I think the business has continued on the steady path. There's nothing that has significantly changed over the last 2 months. Having said that, yeah, around 55 to 60% is our revenue mix as far as lab-grown segment goes. So that is the size of the business that we have from the lab-grown segment.
Ishwar, the thing is that with GIA, which is a very big certification, body, and it's more about the messaging that's going out in the market. And do you see any impact of this whatsoever? That till now the comfort was lab grown, also has the 4Cs. It's a diamond made in the lab. But now there's a very clear effort to drive a very clear distinction and segregation. Will that not put some pressure perhaps on demand, on the pricing of the certification? What happens to your business?
See, I think this is what we discussed over the last 2 or 3 times that we've been on the show. I think the lab-grown segment is an emerging segment, and it's going to be a large volume play over the next 3 to 5 years because of the way it has shaped up over the last 5-6 years with its affordability factor. We are assuming that a lot of many consumers are going to come into the fray, and that's the reason why we've seen even during Q1 of this year over 20% of volume growth.
No, Ishwar, I was just coming at, yes, of course, that's the long-term story. I'm talking about the pricing of the certification. How much, say, are you making on the certification of diamonds right now, lab-grown and natural? And will the pricing of that certification change with what GIA has done?
See, we mentioned this during our last call. I think we make around $15 per report as far as lab-grown certification is concerned. But having said that, this 4 Cs that we've been, is the basis on which the diamonds have been graded. It's close to a century. The 4 Cs have been the standards at which any diamond gets graded. Now, having said that, there is absolutely no difference between a natural diamond and a lab-grown diamond from a physical or a chemical standpoint. And, so we in IGI believe that what is paramount importance is the way we are providing information and transparency to our consumers. From that standpoint, I think we have the scale, the expertise to provide reliable, independent grading.
So you will continue with the 4 Cs, Ishwar, for lab-grown diamonds. You will continue with 4 Cs.
Absolutely.
So I'm just trying to understand if I'm if I'm a diamond operator or even a jewelry operator, and if I have lab-grown jewelry, will it be cheaper to get a certification from GIA versus IGI? So therefore, won't that impact business?
See, the pricing between IGI and GIA has a difference historically. I think that difference will continue to exist. But having said that, with the lab-grown coming into the fray, I think it's paramount importance that consumers get that sort of in-depth information rather than just making it extremely simplistic and generic. So from that context, IGI will continue to provide 4 Cs irrespective of whether it's natural diamonds or lab-grown diamonds.
All right. Hi, Ishwar. Good morning. Good to see you. When Surbhi, I thought she was saying, if I'm going to go, I thought Surbhi is off to buy a diamond. That we'll have to see what happens on that front. But Ishwar, you told us for a certificate lab grown, I think you said around $15. If I remember correctly, a natural diamond, it's around, it's more than double, right? I think it's around $35. Is that correct?
That's right.
So that'll be a big margin difference as well between the two?
No, but see, as I mentioned earlier as well, I think the margin differential is also taken care by the volume throughput that happens on lab. So I think what we have to see from a contextual standpoint over the next 3 to 5 years is the scale up of lab-grown diamonds, both loose as well as jewelry. And as I mentioned on our call last time as well, we are also seeing a significant increase in lab-grown jewelry, which could be the big player for the industry as we get along the path as lab-grown settles in. So from that context, I think this is just the beginning of what we think is going to be a very, very large cycle as far as lab-grown business is concerned.
But Ishwar, I think the street's worry would be that whether that realization of roughly $15, whether there is any downside risk to that, will there be pressure on your lab-grown diamond certification realization with what GIA is now doing? Is there a risk?
See, I think IGI is the market leader as far as lab-grown diamonds is concerned here in India. And over 70-75% of the produce happens in India as far as lab-grown is concerned. So I don't see any significant pricing pressures on our business. And it's been more or less stable in the last 3-4 quarters. It's more got to do with the way the lab-grown segment itself has behaved. So we are seeing a lot of stability as far as pricing is concerned. And we must remember that while there's been a slight dip in LGD pricing, that's more at the wholesale level. At the retail level, it's been very strong. It's again completely a brand equation there, which finally determines at what price it gets sold at the retail level.
Okay, all right. Ishwar, a quick couple of questions. Do you see the need for certification going down, particularly in lab grown, because your mix, from 60% has come to around 54%? It could be because the other segments are growing faster. But this is one point that the street gets a little bit nervous on, the need for certification going down. Yes or no? You don't think there's no truth in that?
I don't think so.
Okay. All
we
right.
discussed this in the past as well, so I don't think there's going to be any pressure there.
But we need to put forth some of those concerns of the street, right? I mean, I take that point. I'm looking at a note as well coming in from Investec, and they are talking about your solid ROCs of around 35%, higher margins as well. We get that point. Very quickly, before we let you go, tell us the total volume target that you have for this year, if you could help us out with that, what it means in terms of revenues as well as margins. 3 quick numbers as a revision. At the end of quarter one, we'll squeeze you a little bit more. But for the year, what are these 3 numbers that we should work with?
Yeah, I think we'll stick to the guideline that we had given last time. It's a 15-20% revenue growth is what we're looking for this year. And margins, I think, we improved by some 700 basis points in quarter one. I think the same range, which I had spoken last time, between 57 to 64. I think that is a range that we are continuing to look as we progress during the course of the year.
Okay. All right, Ishwar. Thanks very much for joining in and fielding all of those questions. Appreciate you giving us the business view today on the show. Well, that's IGI sounding still quite confident. They don't think that this latest salvo from GIA about changing the way lab-grown diamonds are certified, they don't think that's going to impact their business. All right, let's move on then. India's wine industry is in focus, and we're putting the spotlight on Sula going forward. Now, the country's wine industry is bracing for a shake-up with foreign trade agreements, including the UK FTA already signed and talks progressing with the EU and US. Imported wines could perhaps soon hit Indian shelves at sharply lower prices. Sula Vineyards CEO Rajiv Samant tells CNBC-TV18's Shireen Bhan that the sector has been preparing for this, but is urging the government to enforce a minimum import price to level the playing field. Here is a slice from that conversation.
You know, one of the big changes that we're potentially going to see in the Indian spirits market, in the wine market as well, is going to be foreign competition. Now with the FTAs being inked or likely to be inked, the India-EU FTA, the US FTA as and when it happens, UK has been done. And, you know, the Alco-Bev industry is saying this is bad news. How do you see it?
It's happening. And it's something that we have been gearing up for the longest time. We've always known, and we've been told by Commerce Ministry officials that, look, what we have here is not going to last forever. Gear up, be ready. And now it's here. So there's a lot of work that we need to do to gear for that. The market is going to expand. There's no question about it. I do believe that there should be a minimum import price. That's something that we've made our position very clear to the Commerce Ministry, and we are always in discussion. So we do have a seat at the table, I must say that. They're very aware of the fact that this is one of those few very farmer-friendly industries that's actually doing well. But yes, it is coming. There are going to be cheaper imported wines available. We also have to see whether we also want to play more in that business.
Yeah, I was going to ask you that.
But, you know, our wines have to speak for themselves. They have to speak for for Nasik. They have to be of quality and of the price that appeals to the consumer. At the end of the day, you can't get away from that. And I do believe we're in a far stronger position today than where we were 10 years ago. We are ready to compete.
So, you know, you said you're ready to compete. What's the strategy going to be as and when we do see the changes take place? Because a lot of these FTAs are still work in progress outside of the UK. But, you know, what is the strategy going to be? And going global, you know, we're talking about people entering India. What about Indian wines going global?
So Indian wines going global, that's going to be a little bit of a tougher proposition.
Why?
I think that Indian spirits probably have you know, they have such a long history. Indian wines are a little bit new, you know, competing with French. Let's talk about in India. You know, we have maybe a 6-month window in which we got to get our wines onto every single list. Once your wine is on a list, it's much harder to get it off. But if it's not on the list in the first place, then when you have your imports coming on, those wines are going to probably come on there. So
you're really factoring in just a 6-month window?
Absolutely. Absolutely.
That's not a very long window.
It's not a very long window at all. So we are just working double right now to make sure that putting our wines in front of more people, boosting our tastings and experiences, getting on every wine list, boosting availability. That's what we're after right now.
So, you know,
those are the kinds of sort of nuts and bolts things that you got to do. And of course, quality has to speak for itself. Now you have a few different kinds of consumers. You have consumers for whom they always go for imported and foreign. But you have enough consumers also who are looking for something good that's produced in India, and they can say with pride, what I'm buying here from India is easily as good as what I'm going to get from imported at the same price point. So we're going to appeal to them.
You know, going back to the India-EU FTA, and What is the ask, if anything, outside of do a minimum import price of the government, considering the fact that, whether it's the EU or other countries, subsidies are fairly high, even in this sector? Is there a wish list that you've given the government?
See, we make it very clear, EU and UK are quite different. The UK doesn't give that much subsidy, for instance, to their spirits companies. The EU, on the other hand, for them, wine and vineyards is so important. They give something like 1 billion euros a year in support in one way or the other.
1 billion euros a year?
1 billion euros a year under their common agriculture policy, the EU CAP, to their wine and vineyards. I mean, that's huge. How are we supposed to compete? We get a smidgen, maybe our wine industry gets €500,000 a year from the center. What we have had until now is tariffs. So we always point out that there's a big difference between spirits from the UK and wine from the EU. How are we supposed to compete when wines come in at €0.50 a bottle, which can happen? But I do believe that the Commerce Ministry is very cognizant of this. And so, let's see.
All right, that is Mr. Samant of Sula Vineyards saying that how is Indian industry, the Indian alcobev industry, particularly wines, how is it supposed to compete when you have a war chest of 1 billion euros in subsidies every year that the EU is giving to the wine industry, whether it's France, whether it's other countries. Interesting times. Let's see how Sula competes. But from wine, we're back to technology now, and the next company on our radar is Tata Technologies. We have with us the top management to discuss the global uncertainties and how the companies navigating these uncertain times. Warren Harris, CEO and Managing Director at Tata Tech, is with us. Mr. Harris, great to have you with us this morning, sir. Now, last time we spoke, you were quite hopeful of things settling down by the middle of this year, and now we're in June. But I don't know if things are any more certain than that last conversation. How do you gauge the demand environment at this point and how decision-making is shaping up within clients?
I think from our perspective, things are playing out as we anticipated. We started the year with a great deal of confidence. There was a lot of latent build-up of new product investment that we were seeing across our customers. And then, of course, on April the 2nd, Mr. Trump's so-called Liberation Day, the announcement of tariffs prompted everybody to sit on their hands and pause for a moment. But I think what we've seen over the last 6 to 8 weeks, despite the ongoing uncertainty, is really a commitment of many of our customers to look beyond the sort of tariff distractions and recommit themselves to the product plan. So, despite the fact that Q1 is likely to be soft for us in terms of new deal signings, we've had a very good quarter, and I think that augurs well for Q2 and certainly a very strong finish to this fiscal year.
Okay, so that sounds good. You said first quarter could be soft. Now, auto as a segment we know has been already going through several quarters of softness. So could Q1 be the third negative growth in auto particularly, or do you see some sign of revival here?
I think we're still working hard to try and deliver an acceptable set of results. But I think given the right shifting of many of the decisions that we were expecting in April, things are likely to be challenging in this quarter.
Well, Mr. Harris, given the slow start to the year, do you think you'll be achieving the double-digit revenue growth in FY26, or is it a tall ask?
I think that's still very much our ambition, and I think again, as we, as I referred to before, deal signings are very strong, and we're seeing that certainly in automotive. I'm going to the Paris Air Show in 2 weeks' time. We expect to be able to announce a couple of deals at the air show, and so we are still bullish about improvement in Q2, and again a very strong second half to this fiscal year.
Okay, got that point. Now, you said that deal signings have been fairly solid. Can you give us some sense? I mean, what is the pickup in the overall deal signing pipeline compared to last year?
Certainly materially better, and not just better than Q1 of last year, but better than Q4. So we are starting to see a build-up of order book. And again, that underpins our confidence for the rest of the year.
All right, Warren, on the rare earth magnet disruption, multiple European automotive component manufacturers, they have halted production in response to the export curves. Any of your OEMs have been impacted? And will this be an added reason for softness in the first quarter of this fiscal?
Well, we've certainly not seen any of the concerns with regard to rare earth materials getting in the way of production or again in terms of investment. What we are seeing is many of our customers leverage technology to interject resilience and flexibility into their supply chains so that they can pivot if there are issues and challenges associated with either a shortage of supply or again the macroeconomic or geopolitical issues. And that's providing us with opportunities. Not only are we in the product engineering space, we also help our customers select and deploy the technology on which new products are designed, developed, and conceived, and that includes supply chain capability. And so we're seeing an uptick in terms of the digital requirements of our customers, and we are certainly very excited about our ability to intersect with that and deliver value in that area.
Okay, all right, understood that. Now, some of your biggest clients, JLR, Tata Motors, when we've spoken earlier, you did mention that JLR continues to see challenges. Given their big global exposure, Tata Motors is relatively better off because they're more domestic facing. What do you see ahead for Tata Motors, JLR?
I was at the JLR supplier event yesterday. The top 50 suppliers of JLR got together with the JLR board and their extended management team, and I was incredibly impressed with their product plan, with their commitment to invest in new product, and the launch schedule that they have positioned for the next couple of years. They have done very well financially last year. I think that they were a little concerned about the trade issues between the UK and US. I think we've got some clarity now, and they are very much pressing ahead with their business plan, which augurs very well for the partnership between ourselves and JLR.
Well, Mr. Harris, I need to probe you a little bit. When you said that quarter one will be soft, are you referring to only auto or even the non-auto segment? I ask this because the non-auto actually has been very, very strong for you.
Yeah, we've really not seen any drop off of the momentum that we've seen in aerospace. Industrial heavy machinery has been relatively strong for us. So the softness is really in automotive, but automotive continues to be the largest vertical for Tata Technologies, and so as the automotive business goes, so too does our prospects. So we're very, very focused upon making sure that we drive improvement in that vertical.
Okay, all right, got that point. Finally, does TPG's exit impact business in any way, Mr. Harris?
No, I don't think so. We'll continue to stay very close to the TPG team. They continue to be an investor in Tata Motors. I think they've made some strategic decisions in terms of their investment thesis, which has prompted them to pull out of Tata Technologies. I do not think that it relates directly to any concerns that they have in us. And so, we were very proud to have them as a shareholder, and we'll continue to rely on the relationships that we've got there, because they've got some great people, not just in India, but around the world, that have great insights on the markets that we serve.
Okay, all right, Ms. Harris, appreciate you joining in. We look forward to touching base post your quarter one numbers, and we'll get some further clarity as well. But thanks a lot for speaking to us here on CNBC-TV18. Well, that said, let's move back to the markets then. And the Nifty is still holding with gains. The Nifty Bank is well towards that 57,000 odd mark, but we've come off a little bit from the highs of the day. Midesh Thakur is back with us. Midesh, someone who has, played these last 500 points, what would your advice be? Take some money off the table or continue to build long positions, and also help us out with a couple of your picks?
Yeah. Well, yeah, I think only indexes I would still suggest that between the two, I think Nifty could yet be added. even with the stock below 25,000, so you will have about 110 point kind of a risk. And I believe the 25,400, 500 looks to be very likely targets in the short term. So we're getting a positive bias there. On the stock side, NHPC is something which is maybe buy today, buy here with the stock below 90 half for target 96. And the other one is Power Finance Corporation, which I would recommend buying with the stock just below levels of 419 for targets of 44.
Okay, all right. Thanks very much for that, Mitesh. We'll, of course, touch base with you later during the course of the day. Right now, a quick break. Come back on the other side and we'll, of course, get you the latest on commodities. Manisha will be joining in. Welcome back. As promised, let's do a quick update on the latest from the commodity world. Now, we spoke about oil earlier, which has been a bit on the boil. Let's also talk about some of the precious metals that continue sparkling. And we have the precious lady with us, Manisha Gupta, in the studios. Manisha, what's the latest?
Well, Sylvia, I'm not going to talk about gold today because we've seen all-time highs onto that, and gold really seems to be consolidating anywhere between $3,200 to $3,400 an ounce on the higher side. What really seems to be doing a strong catch-up really is the other precious metals. Silver, for example, we're trading at a 13-year highs for the international markets there, and for the Indian markets, we are holding close to those all-time highs of 1,05,000 rupees a kg. Prices have gained up by 8.5% in the previous week, and we are 25% up in 2025 so far when it comes to silver. Well, it is about strong investor interest. A lot of physical buying in the Indian markets also seems to be happening. And then the industrial demand has been strong. It has been about the ongoing supply shortages that the street is also dealing with. Remember, 2025 is a fifth straight year, where you are looking at deficit continuing in case of silver there. Also, the industrial demand, while last year was less than 700 million ounces, it is expected to be more than 700 million ounces in 2025. Silver is also used in solar, electrification, and that is where we are looking at demand coming in from. So silver is something to watch out for, with market anticipating that 36 is where we are trading right now, but it could be heading at 38, even $40 an ounce by the time we are at end of this year. And it's not just silver. Take a look at palladium prices because we're trading at near highs there as well. Platinum is trading at around 13-month highs also. For platinum prices, we're looking at $1,175 an ounce or thereabout. Platinum also has gained up by nearly 12% in the last 1 month. It is up 11% in the previous week. And the platinum prices have gained up by 32% in this year. So clearly outperforming gold, outperforming silver and palladium as well. So platinum is your best performing metal within the precious metal space at this point in time. Well, we are looking at World Platinum Investment Council data, which shows that 2025 is looking at a supply deficit of around 1 million ounces. The output concerns are also coming in from the South African mines supporting prices. Remember, 40% of aluminum is used for in automotives, and while the demand there could be slightly on the weaker side, but it really is about supplies which are supporting. And then the jewelry demand for platinum in the Asian markets, especially Asia and China, seems to be picking up as well. And the last on my radar is palladium prices. We are trading at around 17-week highs onto this one as well. Palladium prices have gained up by 12% in last 1 month, 7% in previous week, and is trading 19% on the higher side for this year as well. So almost everything in precious metals now is glittering.
Okay, so it's glitter and sparkle all the way. Silver doesn't want to be left behind. Gold for sure. Thanks for that, Manisha, very much. Well, coming back to equities for just a bit, a spotlight specifically on Tata Motors, and the stock has been holding higher since morning. Sur is joining in. I think, Sudarshan, there's an investor call today lined up. Has it happened or is it happening today?
It's a whole day event. So Tata Motors is holding Investor Day today, and JLR will hold Investor Day on June 16. So ahead of Investor Day, Tata Motors has released the outlook for both its segments, PV business, that is passenger vehicle segment, also for commercial vehicle segment. It has given the outlook especially for passenger vehicle, that is for FY26 and also for next 2 to 3 years. So first, talking about commercial vehicle business, that's the company has given outlook for FY27. So first, talk about the market share. It's saying that by FY27, it's targeting to achieve market share of 40%. And current market share in commercial vehicle segment is around 34%. So almost 600 basis points that company is targeting to gain on the market share front. On the capex, it's saying that will be 2 to 4% of revenue, and on free cash flow, it believes that it will be 7 to 9% of total revenue by FY27. That is of commercial vehicle. Now coming to passenger vehicle business. So it's well known that FY26 is going to be muted for the entire passenger vehicle segment. If you remember, SIAM also has given the industry outlook for passenger vehicle growth that is of 1 to 2% versus FY25 growth that industry had seen that was in the range of 3 to 4%. On the backdrop of that, Tata Motors is saying that demand growth is expected to be muted, competitive intensity to remain high, and one segment that is going to see healthy growth, and that segment has been seeing healthy growth, is the SUV. And also company believes that there is a limited headroom in changing segment price points, at least as far as FY26 is concerned. But now going to beyond FY26, the outlook for passenger vehicle segment is also looking healthy. First, company is saying that it's targeting that volume growth will be well ahead of the market, and here market share companies targeting of 16% by FY27, and that would be including of electric vehicles, and 18 to 20% next 2 to 3 years. And current market share in passenger vehicle segment, including electric vehicles, Tata Motors has is of 12.9%. Also, and on EBITDA front, it's saying that it will be double-digit EBITDA. Now, on EV front, company is saying that penetration of electric vehicles will increase to 20% by FY27 and more than 30% by FY30. And positive EBITDA will continue for electric vehicles, while free cash flow will remain negative in the medium term, but business remains well funded for next 3 years. So overall, positive outlook for FY26 and beyond.
Okay, got that point. Sudarshan, thanks very much for that. Tata Motors in focus, stocks holding higher by 1.5%. Let's take a break on that note, but don't go anywhere, because coming up on the other side is our special segment, It's the Economy. Today, Lata speaks with George Alexander Muthoot of Muthoot Finance on the easier gold loan norms that were announced by the RBI on Friday.
Welcome to It's the Economy. Besides the rate cut, the Reserve Bank showered a bunch of relaxations on gold loan companies compared to the draft gold loan rules that were released earlier. Now banks and NBFCs can give loans up to 85% of the value of the gold collateral for small loans under 2.5 lakh rupees, and they can give up to 80% of the value of the collateral for loans under 5 lakh. For loans above 5 lakh, of course, the old rule of 75% of the collateral remains. However, loan value will include the interest payable, and that may hurt some who have not been including. Also, for small loans, self-certification will suffice to prove that, the borrower owns that gold. However, the loan value will include principal and interest, as I told you, but this might affect some NBFCs. To understand how gold loan companies are going to be impacted, we have with us George Alexander Muthoot, the Managing Director at Muthoot Finance. Good morning, Mr. Muthoot. Thank you very much indeed for joining us. Well, first up, at the moment, what are you giving at? What is the average LTV? And therefore, this 85%, what difference will it make?
Good morning. And today, the maximum we give is 75%. That's a given today. And if you take it the average LTV, which is on our books today, you see the amount of gold we have with us and the amount of loan we have given. It is only 58%.
Oh, okay. So you have a lot of headroom. But does your loan, this 75% that you give, did you include the interest which the Reserve Bank now requires you to?
Today it is not in vogue. Probably after the rule kicks in, maybe next of April, we'll have to see the interest part also and then take a call on that.
Oh, so you mean you can't give 85% now? You can give that 85% only from April 1, 2026?
That's what I think. That's what I understood. That's what I understood.
Okay, I thought by April 1 it has to be complied with. So I was under the impression you can start immediately. Okay,
no,
you start.
We'll have to get it clarified.
Okay, I think that requires a clarification in that case. Mr. Muthoot, how does your cost of finance change? Because there's such a big tap that has been opened, both liquidity and rate cut, do you see a sizable fall in the cost of funds for you? Can you quantify it?
No, I don't think it's a sizable fall. Definitely a fall will be there, but probably it will take 1 or 2 quarters more for it to really trickle down to the loans which we take. See, our funding comes from banks and NCDs, non-convertible debentures. So it will take a time, maybe 1 or 2 quarters for it to really come down to trickle the trickle effect of the rate reduction to reach us or reach our borrowing. Will take little time, maybe a quarter or 2 quarters for it to come down. So we see some contraction in the interest rate.
But are not your a clean loan from a bank, is it not linked to repo? Should it not be immediately 0.5% lower?
After quarters, etc. There are so many conditions. It is not every day fixed. Just lift on the rate is set, I think, every 6 months or 9 months or something like that. It's not that easy.
Oh, okay. So in any case, for an outsider, it looked like you get more bang for your buck because you can give, 85,000 rupees for a 1 lakh collateral, whereas earlier you could give only 75,000. Plus you have this hopefully 0.5% lower cost of funds. It looked like a double advantage for people like you. Just quantify the margins for us. How much will it be this quarter? How much could it be next quarter?
See, when our cost of borrowing comes down from bank loans, when it comes down, we actually pass on the rate cut to the customers. So we reduce our yield. We maintain our NIMs and our spread so that the NIMs of maybe 11% and the spread of 9% is all what we maintain. So whenever there is a reduction in the cost of borrowing, we pass it on to customer. Whenever there is an increase in the cost of borrowing, we actually increase our yield also. So, but then the availability of fund, I think we are missing the point. The availability of funding from the banks is going to increase, and that is the big good part of this. The good part of this is that availability of funding is going to increase.
Okay. No, I'm just reading the timeline of your yield. your margin rather. Your margin was 6.75 first quarter of FY25. It rose to 7.11, then 7.02. And the last quarter you reported, you had a margin of 7.3. So it's a clear increase in margins that you have reported last year, FY25. So should we expect even better?
Are we looking at the margins, or are we looking at the
I'm not looking at the spread. I'm looking at yield on loans minus interest expense. Your yield on loans was 18.5 according to your investor report, and the interest expense was 11.2 for the quarter gone by. And so your net interest margin you reported as 7.3. I'm just asking if it will be higher.
No, I think it is reported. It is close to 11%. Between 10 and 11.
So your spread, that will be your spread.
The own funds in that. Own funds about 28%.
Oh, okay. So how much will it, in basis points, can it go up by?
The NIMs won't go up. It will remain stable. As I said, if the cost of borrowing comes down, we will reduce our yield.
All right. Okay. Can you tell us something about the volume of loan growth? Because it was a solid loan growth volume even in the quarter gone by. But does it do even better? Because you can give more, there's more bang for the buck.
Yeah. I think when fund is more available, we'll have to do more. So we have given a guidance of loan growth of 15% is what we usually give every year. Of course, I know it is very small compared to actual.
It's very conservative. You do so much more than that.
I know. But usually when we start the year, we tell 15%. We revise it after the first quarter, second quarter. So we'll just wait for the first quarter to do a revision. Certainly there will be a revision because business is doing very well now.
Okay, so you're likely to revise the gold loan further. What is the expectation in terms of expansion of branches? Okay, before that, you also don't have to do too much due diligence now under the new rules. They are not asking you to do end-use diligence only for priority sector loans, which is a banking problem, not your problem. So does that reduce operating costs?
No, operating costs definitely will go up only because certainly compliances, etc. Every quarter on quarter, every month on month, compliances are increasing because we have to comply with so many things. So compliance cost is definitely going to, not that it is going to be very high, but certainly it is increasing. But fortunately, because our book is also growing, we are able to average out the compliance cost. That is a big advantage we have because of a big book. Otherwise, for small companies, etc., compliance costs and starting companies, etc., compliance costs will be very high. As you said, compliance cost is only increasing.
Oh, because you don't have to do end-use monitoring, there is no advantage?
Today also we don't need any monitoring. We don't do any monitoring. Definitely, we don't do any monitoring today. And if we don't have to do again, so it is status quo for us.
Okay. What is the expansion plan? Will you be going more into, buying up any company, any other, inorganic expansion plans?
Yeah, of course. We have 5,000 branches in the main company and probably about 1,000 branches in the subsidiary. So that is a good number we have. Usually we go for about 100 to 200 branches every year or 200 branches. So we have got license for about 115 branches now. I think the next 3-4 months we'll be opening that also. And probably after that we'll ask for some more branches. Not that we need too many branches because branches are also not that easy to maintain. So 200 branches, etc. every year is what we have been doing. I think we'll continue to do that.
Fair enough. So no inorganic headlines you are giving us.
No inorganic thoughts have come to us till now. No inorganic.
Okay, finally, Mr. Muthoot, banks are also going to have these advantages. 85% LTV and, of course, at the moment their costs have not fallen, but it will fall given the liquidity. Do you see more concerted competition from them, more intense competition from them? Will that have an impact?
I think the base of gold loan business is actually increasing. Last year, many banks did 50%, 60% growth.
Yes.
Muthoot also did 40% growth. So the pie is, the base is increasing. more and more people are coming to take loans. Today, every time there is at least 2 or 3 news in the newspaper, in the media about gold loans, gold price, etc. So people are getting, what should I say, people are giving more importance to gold. And probably more and more people are now resorting to gold loan and seeing it as a smart loan. And that is a change which is happening. People are seeing this as a smart loan. The pie is increasing. More and more people are using gold loan as a good and quick means to get loans. So banks are there. So many banks with maybe 75,000, 85,000 branches. They are also giving gold loan. NBFCs are also giving gold loan. The base is increasing. It is not that somebody is taking away our business.
Okay, I get it. The pie has increased.
Are actually increasing day by day.
I get your point.
There's space for everybody.
I get your point. The pie is increasing. Just give me a number, sir. Like you said, your spread has been between 9 and 10%. FY26, will it be closer to 10 or closer to 9?
No, we will maintain the same thing. Because our profit should come from the more turnover and more business. It should not come from the NIMs increase. NIMs, I think what we have is the same. We will continue to maintain that.
All right, we'll leave it at that. Thank you very much, Mr. Muthoot, for joining us. And here's hoping FY26 turns out to be a prosperous one. Well, we have to wrap up on Bazaar on the note that the markets are in, full-blown cheer, and that is to be expected. There is such a big steroidal boost coming from the Reserve Bank that I think the bulls are in a very, very safe spot. We wrap up on Bazaar. Chartbusters after the break.